Hello, everybody, and welcome to another episode of Veriff Voices. This is the podcast where we talk about fraud, compliance, technology, and all things related to digital identity and restoring trust to the internet. The focus of today's episode is going to be on Perpetual KYC, which is a very sort of specialist subject. I'm glad I've got an expert here to join me. Alex Buckwald is head of EMEA Client Insights at Alloy, who are a partner of Veriff. Alex, welcome, first of all. Thanks for your time. I know you're incredibly busy, so it's great to have you here with us. Do you just want to give us an intro to yourself, first of all? Just sort of who you are, your kind of journey to where you've got to so far.
Yeah, sure. My name's Alex. I run post-sale, basically, at Alloy in the UK office. I've been working in digital identity space for far too long, probably like 8-9 years now, both on like vendor side. So I started my career at a company called Onfido, who I think a lot of people in the space will know as kind of being one of the first in London to do a lot of digital identity. I worked there for a number of years, kind of on and off. From there, kind of saw everything from nascent kind of digital identity through to biometrics, through to like how you can do some of that basic kind of pKYC stuff with ongoing checks. From there, kind of left just before they exited, joined a cybersecurity startup for a little while for my sins, and then have wound up at Alloy in the last year and a half, where we kind of do that digital identity piece, but on the other side, we're orchestrating as opposed to providing all of the data that goes into verifying someone. Yeah,
and just to tell us a little bit more about Alloy, then. As I mentioned at the beginning, they are a partner with Veriff, so we do a lot of business together. But just tell us about kind of Alloy's USP, if you like. I know it's kind of very financial services focused, but tell us a little bit more about that and what it is that you actually do for those kind of firms.
So Alloy, in a nutshell, global identity orchestration platform. It's a lot of buzzwords, but in a nutshell, it means that we work with a number of partners, Veriff included. We use data that our customers provide us, and we have some data that we own ourselves, which we use to help banks, fintechs, and payments companies meet their compliance requirements. The big plus there is they can hit higher straight-through processing numbers. So if they're needing to onboard someone, rather than having someone manually review it, the aim is to get someone from, hey, I've signed up, to, hey, I'm using the tool, without needing to hit a manual review, without needing to wait days for some kind of decision to take place. We do that with the help of our more than 200 data partners. So we work with a lot of different services globally to help give us the data that we need to onboard people seamlessly. And we operate globally as well. So we're in the US, which is where we're based. We operate in Canada, EMEA, and we're becoming more and more global. So we entered the UK market a while ago. Globally, we've got 600 customers. And in the UK, some of the customers that listeners might have heard of are IG Group, Flagstone, WorldPay, Liverus, and so on. So we're growing steadily in this market.
It's great to see, and I think I've been aware of Alloy for a long, long time, and I obviously know the work that you do with Veriff, and it is an incredibly niche space in some ways, financial services, and I think we'll get on to some of the reasons why that is later on, actually. But let's start with, this sort of concept of Perpetual KYC is kind of what we're sort of the main topic to sort of talk about today. So let's just have a kind of level set of what that actually means to you, I suppose, and a little bit of definition, and why do you think it's become, on top of that, why do you think it's become such a sort of hot topic in the sort of identity space?
pKYC, kind of taking a step back, if we look at the traditional approach, which is periodic reviews. So you on board with a company, and assuming you're low risk, you're a good actor, you want to use the company for all of the things it's meant to be used for, and you're not going to do anything bad with it, that company may not want, or need rather, to perform any additional checks or verification on you for, let's say, 3 years or 4 years, whatever their internal regulation says. And that's kind of the old world of periodic reviews. There might be occasions where some element changes. So, most commonly it's like watch list monitoring. So suddenly your name appears on adverse media or PEPs or sanctions lists. They're probably going to want to do something about that the day it happens. And that's kind of always been the case. So you kind of got this periodic approach where the majority of the profile is verified a set period of time, and that's going to vary on risk level. Yeah. Then you have kind of the watch list side, which is more of an ongoing piece because that stuff is very real time. I guess the shift that we're seeing and the reason and kind of what is pKYC is this shift from point in time, kind of periodic reviews, to something that's more continuous. And something which gives you that overview of a customer profile throughout their life cycle with you as a business. Right now, customer data is kind of refreshed on that multi-year cadence. This is more about bubbling up the really important parts of any changes that happen to that customer as they happen, so that compliance team can review them, action them, escalate them without them becoming a big problem. And I guess it's becoming a hot topic because fraudsters are moving faster.
Yeah.
Regulators want to see companies not just meet the regulation, they want to see them go that little bit beyond. And ultimately, companies in the space want to do that as well. They don't want to just check the box that says we are compliant. They want to provide, kind of at the end of the day, trust to their customers that they as a platform are one that if you need to put money into them or you need to send money through them or whatever else, they are a safe pair of hands. And the way to do that is to have that ongoing monitoring. And it's, I guess at its core is just a real shift in the industry. It's moving compliance to something that is more dynamic and proactive.
Yeah.
Making it more of a USP for companies as opposed to it just being, hey, we need to check Chris 5 years after he's onboarded because that's what the regulator has told us to do. Yeah,
you're right, and I think it's one of the things I'm seeing is this kind of there's almost a separation between fraud prevention and compliance in sort of the old world, and I think that this is bringing those two things together, right? Absolutely. And I think that that's a very positive step. From your perspective at Alloy, what do you think are the biggest risks or kind of limitations if you have that kind of if you are treating KYC as a sort of a scheduled process as opposed to this kind of live, ongoing, organic kind of thing? What are some of the risks involved in doing it that sort of formal way, would you say?
So I think for me, and from what I've seen with customers, it's really that you can miss things and that you can miss really big, important things that you probably don't want to miss. I think, as I said, like the watch list monitoring side of things is quite well done. And that's probably the scariest thing that you could miss. So sanctions or someone getting made a PEP that suddenly creates risk for your business, you don't want to miss that. And you probably won't miss that given the way things are set up today. But what you might miss at the moment is, for example, someone onboarding is low risk. God forbid they were a bad actor, they've onboarded perfectly, and they start doing things in your platform that might throw up alarm bells. They might be small things. It might be changing their bank account. It might be they've changed their email address or their phone number. It might be an account takeover attempt. All of these small kind of actions that you may well be monitoring in isolation, but you're not doing across the customer profile, are things which could eventually escalate up into something which causes either reputational damage, which is most likely, or potentially a visit from the regulator asking why X amount of money has been kind of laundered through your platform in a worst case scenario. So that for me is the real risk. And I mean, we've seen kind of low level indications of this even today where customers have kind of indicated, hey, what should we do given this person's job code has changed? Like they joined as a retail assistant, now suddenly they're earning X amount more money. Like how can we validate this? So pKYC gives you a way to do that in a way that periodic really doesn't, where stuff might just sit for however long it takes for that periodic review to roll around. I think that for me is the core reason. I think the other side of it is periodic reviews can be pretty intensive. Yes, they happen on like that regular basis, so you can kind of prepare and plan for them. They're not all happening on the same day. But they are typically quite a manual process at the moment. It is something which a lot of businesses I've kind of spoken with have struggled with, because they found that although they can automate elements of it, they're still having to have their compliance team go in, review a cohort of people. They get behind on their manual reviews. Suddenly that periodic process that's meant to happen every 3 years is suddenly taking longer and longer. It's painful for everyone. It then starts to impact the customers, which I guess is the third thing. It just creates a bad customer experience where suddenly you, as the user of this platform, being asked for your life history on a cadence which may or may not make sense. If you're fortunate, the business that you're working with has risk scored you and maybe they're not asking for everything. If you're less fortunate, maybe they are. And maybe they're just doing a complete recheck as if they're onboarding you fresh again. Thankfully, that doesn't happen so much now, but that is still a risk with some of the larger financial institutions.
Yeah, and I think as well, the 3-year window with the speed with which technology moves these days. I mean, 3 years is massive, isn't it? I mean, you just think what's changed in the last 3 years as an example of that. And I think that things move very, very quickly. And I think maybe something we haven't mentioned yet is that we've also got the tools to be able to do this on a frequent basis now. We don't have to wait. There is the technology that can provide that sort of live customer data as it's happening. So there's no real excuse not to be doing it, I suppose. One thing I just want to quickly focus on, I think we sort of touched on it quickly with that last answer, is around the sort of the regulatory side to this, I suppose. How have the expectations of regulators changed, would you say, especially when it comes to this kind of identity piece and the sort of the fraud prevention angle that's with it as well?
Yeah, so we've started to see more of a shift. Some bumbling up from customers as well, who've been stung, or some of it just coming from conversations we've been having in the space, where there is more of this ask and more of this push from the regulatory standpoint for dynamic checks and KYC to be carried out across customer lifecycle. UK and Europe, really, really hot on this kind of thing.
Yeah.
And we found that, especially at Alloy, as we've moved into this market, that customers are proactively asking us for that ongoing risk-based monitoring approach. And we even saw in our 2025 UK State of Fraud report that some of the biggest things that compliance fintech leaders face, or fear rather, is regulatory and reputational risk. I think over 90% basically indicated that there is a real fear within the industry that they might not meet the regulatory requirement. They might not go far enough beyond it, and they might be hit, as I said before, with that reputational risk of something really going wrong, making it into the news, or potentially impacting other customers, or regulatory risk where the regulator clamps down and says, actually, no, we need to have you do it this way. All of this together kind of signaling that this move to pKYC is starting to be seen as less of an afterthought. We're starting to see people take note of what the regulator is saying and what they're signaling, and start moving in that direction more proactively.
Yeah, it is good to see, and I think that there are a couple sort of angles to this too, isn't there? I think you mentioned that reputational damage to the piece there, which is huge. I think especially when it comes to sort of the customer acquisition angle and that sort of word of mouth, people spreading word going around, that kind of thing. But there's also fines that can come from regulators as well. I mean, in extreme cases, there's sort of license removal and those sorts of punishments as well. So there's a lot that can go wrong with these types of things. I think, and it's really important to establish that kind of regulatory basis to all of this, I suppose. But what we've talked about here quite a lot to come up already is around this kind of user experience angle to all of this, and what are sort of the one of the concerns, I think, with this kind of ongoing perpetual KYC is the friction angle. Like, are we going to give more friction to our customers? Is it going to annoy them? Are they going to leave? I think that's sort of the rough kind of logic that goes into these guys' heads. But how do you see some of the tools that are available these days to combat that? How do you see them sort of striking the right balance between that security piece to the not putting that sort of the overburden onto the customer there?
Yeah. I think a lot of it comes down to both tools you use, but also how you're initially onboarding the customer, right? So I kind of use the example of Chris onboards with a platform, and he's marked as low risk, which should mean that he is a good actor based on all of the checks that were done at that onboarding point of view. And as a result means that potentially his user experience is going to be slightly better than someone who's marked as very high risk. We can do business with them, but there's a level of due diligence here that we need to meet.
Yeah.
And I think you're absolutely right. From a pKYC angle, it becomes even more important, because if you're being asked for your life history every time you make a small change to your account, if you are being asked to provide endless reams of documentation every time you want to change your email address, it's going to start to turn people off, and they're going to start looking for other platforms which maybe don't have that same standard of diligence. And honestly, if you're being asked for endless documentation when you change an email, something is probably wrong with that platform. Yeah. So there is a real balance, and I think you kind of handle that in a couple of different ways. And like you mentioned, we really have the tools now to do that. So critically, it's kind of having these low friction, less intrusive ways in which you can verify someone. So database verification is really popular. You might not want to do that every time, because in some cases it can leave a trace, and you may not always want to do that. In some cases it is entirely invisible, like watch list screening, as we said before. The other side of it is finding ways to make it kind of fit into what people do day to day. So I really like the example of biometric verification. We're all used to it. It's on our phones. all of the kind of modern neobanking apps basically have it as part of their onboarding process now. It's really, really common thanks to companies like Veriff, like Onfido, like others in the space who kind of made it part and parcel of their offering. Providing a document can sometimes be a little bit onerous. You might not always have it on you, but you always have your face. So for me, that's certainly an area where you can start to look at improving that user experience as well. You can start to work to incorporate that biometric auth, maybe for some of the lower level changes that are being made. So, for example, changing an email or changing a phone number, doing some kind of check, at least the first time it happens, or if there are other signals compounding, is kind of a no-brainer and is a fairly lightweight way for someone to verify. Obviously, again, dependent on risk, dependent on a whole bunch of other signals that you're getting. And I think that's the other point here is signals. If someone is making a change and you have the signals that indicate they're doing this from their home or the place they always open the application, all of the other signals they're making are trustworthy as well. That's also all the kind of stuff that you can feed into this pKYC flow and ensure that, you're re-verifying stuff, you're rechecking stuff, but you're also being cognizant of the fact that sometimes people are just sat at home and they're moving house and they're just getting ahead of things. So, just in summary, it's kind of that risk level really organizes that user experience. In the middle, you've kind of got these really cool services now that let you actually start to do it in a way that's less intrusive. Less phone calls asking for documents and more, hey, just show us your face or provide a, tick the box that says you're happy for the check to happen. And finally, just awareness of other signals which come in, which may just be stuff you have today in an application. Yeah,
I think so too. I fully agree with that. And I think in some ways the friction argument is a little bit of a red herring, if I'm completely honest, because the tools we have these days are so sophisticated. I mean, I can speak to Veriff example, obviously, because I know it well. We sort of say that we have kind of three questions that we answer to businesses. The first is can you is this customer real? Do they exist? And that's where the database checks and things are coming as well, so we can verify them against government databases. The second question is this person of value to your business or a potential risk to your business? Are they a fraudster? Do they have a history of untoward interactions or whatever it may be? And then the third question is, can we ask those two questions on an ongoing basis, which I think is where the biometric piece comes in. So technically speaking, I mean, not necessarily from a compliance angle, but from a fraud prevention angle, every time somebody logs onto your platform, that's a potential fraud risk because it may not be the person that's there. So if you can validate that with their facial biometrics, and I think it's a very quick and easy way to get into an account. It literally takes less than a second. So it's one of those things that I sort of, I always sort of bulk at the friction argument a little bit. So, well, actually, really, how much friction do you want? I mean, it's less than a second here. Are you sort of seeing from your customer base, and they're sort of, talking about their end users, I suppose, is there kind of an acceptance of biometrics as kind of a good way of doing business? Or I mean, how do you sort of see it positioned? I know there is some suspicion around data storage and things like that, I think, within the sort of general public at large. But what are you seeing there in that space? I'm really interested to sort of hear about what your kind of feedback would be about that.
So we are seeing acceptance of it, maybe not on every single login, purely because a lot of these companies are app-based, and a lot of them will have Face ID or the Android equivalent or Touch ID or whatever baked in already. And it's kind of layer upon layer. And I guess that acts as your signal as well that, okay, the OS software has told us that this individual is actually the individual who set up the account or owns the phone or owns the device. We're okay with this. Where we are seeing it, though, where we're starting to see that acceptance is those higher value changes within platforms. Okay. So, for example, updating details on the account, which might impact when money is being sent. So, for example, bank account details. It's like one of the easiest things for attackers to go after is just making a change to the account number and sort code. And if that's not secured or locked down, or it's secured and locked down just behind a password, which is, unfortunately often guessable or easily stolen, it starts to become kind of a risk area. Introducing biometrics there, sometimes with a document, depending on kind of the level of risk of that individual again, it is kind of where we're starting to see that movement. Equally, kind of bigger changes to that individual's characteristics as well. So if they're updating personal information, maybe outside of a bank account, making a raft of changes, they're updating their email, they're updating their phone number, they're updating their address, not their name, but everything else, it starts to become, again, that compounding effect where businesses are like, okay, maybe we need to start stepping up the diligence here. Maybe a call to one of the credit bureaus isn't enough. A credit agencies isn't enough. And that's really where we're starting to see that acceptance of biometrics a little bit more.
Yeah.
And that, like you say, that acceptance of a little bit more friction is not necessarily a bad thing in those cases. It kind of promotes the idea of trust. We as a business have this in place to protect you, to protect others, to protect ourselves. As long as you're not hitting them over the head with it every single time, it can be a really helpful thing.
Yeah, for sure. I totally agree with that. We did some research earlier this year that kind of validated that, actually, that sort of showed that, I think it was 76% of end users are prepared to put up with a bit more of a longer onboarding process if it means, in relation to that their data is going to be secure, that their transactions are going to be safe, and so on.
Yep.
I think it's really interesting, actually. And I think that, again, another sort of red herring argument for the friction piece, I suppose. But it just sort of does show that I think people value that. And actually, I think spinning this out a little bit more, it could be argued that you could look at your fraud prevention as kind of a customer acquisition strategy, because if people are satisfied that your measures are robust, they're more likely to sign up, they're more likely to stay with you, they're more likely to say, I think this is a great service, and sort of spread that word of mouth advertising. So all of a sudden, it looks like a marketing strategy as well as a sort of fraud prevention strategy, right?
Yeah, for sure.
One of the things we've mentioned a couple of times is this sort of layered approach. I know that's a phrase that you use quite regularly. Do you just want to explain what that means, first of all? I think that might be just as a definition setter, but also, certainly when we've sort of worked with partners around sort of transaction monitoring and certain things like that too, where there are a number of sort of tools in place to sort of trigger these actions, and at that point, that's when the identity verification kicks in. But just I guess more so in how it fits into this kind of broader strategy of pKYC.
Sure. So for me, at least, layered approach is just that. It's kind of layering the methods that you're using to ensure that the person you're doing business with is still the same person, that they are still trustworthy, that they still meet the same standard to which you onboarded them at. And a lot of that is, as I've been saying throughout, kind of linked back to this idea of risk. It's taking the point of view that someone who is onboarded as low risk is more likely, and in fact, just generally, most people who sign up to a platform are probably going to be good actors and want to use the platform for the intended purpose. So for me, that layered approach is really benefiting them. It's saying, you are low risk. We're not going to apply the same level of due diligence to you as we might to someone who is high risk or very high risk. And in doing that, it really allows you to kind of look at that cohort of customers and use different methods to authenticate them as kind of meets that level of risk. And it really would be layering. So for that lowest level of risk, maybe you can get away with database checks only. It's super low friction, barely even know it's happening, and you can be onboarded in seconds. Maybe as they're kind of using the platform, you start introducing other methods. You capture their document, you capture their selfie, and capture their face, but it starts to layer on over time, as opposed to just being something that you grab all up front, and then by kind of that periodic review mark or that perpetual mark, you kind of have a lot of data on them that you can then use to ensure that they are the same person. Any changes they're making are legitimate. And then on the flip side, that high risk, you're probably doing the same checks, but you're just layering more and more on top. So yes, you're doing those database checks. You may or may not get passes on them because maybe they're from a country or jurisdiction where the data quality isn't good enough. You're introducing document, you're introducing selfie, you're introducing proof of address. You might ask for additional proof of identity. But it's all about kind of layering it on top such that everyone is treated as befits kind of the level of risk that they represent to the business, as well as the level of risk that you're happy to accept. So that for me is that layered approach. Yeah,
and a lot of it comes back to sort of decision making, doesn't it? And knowing the sort of risk signals, I guess, as they are triggered along that process. And I think that ties into sort of my next question, actually, which is around machine learning, AI, and the buzzwords sort of around that too. But what role do you think that the AI particularly has in making pKYC kind of practical and scalable for large financial institutions?
Yeah, I think that really hits a nail on the head. And I think that's like the not the fear, but kind of the look you see in some compliance managers' eyes when you say we can monitor everything perpetually forever and create the cases for you automatically, is just, that's a lot of cases, especially if you've got millions of customers and new ones onboarding every day. But I think it kind of comes in two parts. You've got the machine learning side, which is obviously super impactful. It's kind of working to alleviate burden by trying to build up profiles, basically, of what good and bad look like, and help just reduce that burden off of those manual review agents, off those compliance analysts, off those MLROs, such that they're only dealing with like, tip of the iceberg, and the vast majority is either dealt with automatically or somewhat mitigated, such that they are only dealing with, say, 5% of the work as opposed to 100%. We partner with ML agents, and kind of across the board, this is really the impact that we provide as a company, is allowing you to bring those data partners that you want to work with, whether that's Veriff or whether it's companies like Parcher or Greenlight on the ML side, to start automating that process. And that's the other side, is automation.
Yeah.
There will be some things where ML is kind of your very big stick, and sometimes you need a different tool. Very big hammer. Sometimes you need a different tool in your toolbox.
Yeah.
And automation is kind of the lighter weight version of that. It's allowing you to kind of look at some of the more likely paths that come out of something, and start to automate them away. So I kind of think of it as, hey, Chris has changed his email address. We can put him through a few things. We find out we need to do an additional check. It's not necessarily something you need ML to do. It's something that you can probably just build some logic paths off of.
Yeah.
Maybe the outcome of that would need ML, but odds are it's probably just going to be dismissed and approved, and you're going to be able to continue in your merry way. But in the instance it's not, that's where you kind of start to bring in ML and go, okay, based on the interactions that Chris had with this, based on the information that he's provided to us, that's where we can look at using some of these agents to say, this is good, this is bad. Oh, we need a human to take a look at this as well.
Yeah. Yeah, and I think this is often an overlooked part of this whole puzzle, actually. I think we talk about fraud prevention a lot, we talk about compliance a lot, we talk about user experience a lot, but there is a business efficiency angle to all of this as well, isn't there? And I think, you know, in the old world, it took someone had to go and find this information and say, is this customer legitimate? Did it, had to search it and so on. Excuse me. So I think if you can remove that part of it, and make it as automated as possible, with the right triggers in place and with the right risk scoring in place, so only the sort of select cases are going through to those, to sort of the human manual intervention. I think that's almost the dream scenario for any big businesses, because that's an efficiency, that's a cost saving, isn't it? And I think that you can then redirect those people into doing other more sort of value adding activities, I suppose, in that kind of business too. So I know we have talked about the sort of the partnership between Alloy and Veriff already at the beginning, but let's just talk about it in a little more detail, because I think it would be good for you to sort of share a little bit about how this partnership particularly kind of enhances the capabilities that you can present to your customers, I suppose, when it comes to this sort of pKYC piece.
Yeah, for sure. I think we've been partners for about 3 years now. So
sounds right. Yeah,
2022. And to be clear, Alloy works with a bunch of document verification partners across the space, but Veriff really kind of comes in where we need robust document and biometric authentication, as well as the other checks that Verified provide across the piece, in order to enable both onboarding but also pKYC. And I think it comes back to that point around automation, really. So a lot of changes or a lot of compounding impacts will eventually result in, okay, we need to ensure this person is still who they say they are. We need a document, we need a selfie, we need some other kind of check. In fact, most common example is, as I've kind of said throughout, is, hey, we need to change the account associated with this. That's quite a high profile change. Yeah. We want to make sure the person who's making it is the person who actually opened the account. And in kind of ye olde world of compliance, as you just said, that might be a manual process. It might be a process whereby someone literally gets an alert, looks at it, sends an email to the customer saying, hey, we can update that for you. You send over the bank account. In worst case, it might not even have that. It might literally just be, go ahead and make the change. And that's really where we've seen lots of value partnering with companies like Veriff, is you can start to introduce that without needing that middle ground step of someone asking for the document. We can automate that using Veriff's SDK. And then off the back of that as well, we can decision it. And this is true across all of Alloy's partners. We can take a look at the decision that Veriff provides to us. We can then work with the customer to determine how they want to handle it. It might be, hey, we're happy to accept that. We trust that Veriff or whoever is able to make a decision on this document type with X amount of accuracy, X amount of the time. It might be that based on the response returned, maybe it's a middle ground response. Maybe it's, hey, we're not sure, or there's some issues. We want that to go to manual review. And you might end up with a raft of, hey, we actually need a different document, a new document, or this is an outright reject. Like there's no way, shape or form this is a good thing. And it kind of, in partnering with companies like Veriff, you're really helping those compliance analysts, those MLROs, whoever, those fin crime managers start to deal with the high impact tasks. Instead of having to review 100,000 documents every quarter, they're maybe only having to review a couple hundred at most across like 1 million customers in their customer base, because we're just surfacing the ones which are most important to them. And that's really where you start to see the benefit of a tool like Veriff, is that ability to automate stuff away, to trust that the tool is going to be more accurate than maybe an analyst looking at something through a screen, and that at the end of the day, you can reduce some of that kind of basic work that really is better served by the software. Yeah,
absolutely. I fully agree with all of that. And I think there's maybe another angle to this too, just on the sort of the perpetual element to this, I suppose, is that the risk scores, your decision making can fluctuate over time, right? And I think that's you sort of need to have some tools in there that enable you to change and adapt. And so if you are being targeted by a particular type of fraudster, for example, you may want to raise a particular risk level, or from a certain geography or whatever it may be. Do you think that your customer base sees the value of that as well? Are they sort of quite rigid in their decision making, or is there sort of a growing acceptance of this kind of flexibility towards things?
No, I think it's been really exciting actually. We've seen a lot of customers asking the question proactively of like, how do we mesh together that requirement for pKYC with like changing customer behavior and changing customer risk at the end of the day, and how do we do it in a way that's not going to turn our customers off us? So we're definitely seeing that acceptance toward flexibility. I think that's what's been really cool about all of this. It's not just been, hey, we need to check the box that says we are compliant. It's how can we actually go above and beyond that and start doing things which not just satisfy the regulator, but also satisfy ourselves, our customers, and hopefully the future state of regulation globally. Using tools which allow for that. So using tools which allow them to make that flexible decision making, to automate the process when a customer jumps from lower risk to medium risk or higher risk, or just takes an action which is inherently problematic or could be inherently problematic, is something we're seeing acceptance of, but also like enthusiasm for, which is pretty cool to see in the space.
It is, it does show an evolution for sure. And do you think that biometrics and some of the other tools that we've spoken about today, do you think these things are now becoming kind of the default for financial services business? I think previously they've maybe been seen as add-ons or kind of nice to haves. Do you think they are becoming sort of necessities now? And if not, what do you think are the challenges that are sort of preventing us from getting to that point?
So I think they're definitely becoming more important, especially we're seeing with kind of the EID framework in Europe coming in. We're seeing more companies starting to adopt that, especially in parts of Europe where maybe data quality isn't quite as good. So we're very fortunate in the UK. We have excellent electronic data quality for individuals and identity, which really allows us to verify a lot of people without needing a document. In parts of Europe, that's maybe less the case. Maybe where places are split into provinces or states or whatever, and each province or state has their own method for holding that data. So we're certainly seeing an increased interest in that biometric side of things, especially post that initial onboarding, because it can be such a faff to get people onboarded in the first place. We are also seeing kind of instances where, like you say, initially it's seen as a bit of an add-on. It's seen as, okay, we will do this, and then maybe we'll do biometrics afterwards if it fails, to actually let's flip the script a little bit and let's start with the biometric and document piece, and then move on to the electronic verification, or treat them both the same so that we at least have the record of data. And that's really very dependent on the type of business that's being on board. If it's a business which kind of trades on the fact that it is very seamless and easy to sign up, they might not want to do that. But for larger financial institutions, it's something that we're starting to see more and more of an ask for, because they really want to ensure that they are collecting the maximum amount of data that they can for that risk level based on what they've seen in the past. And then really from there, it's what we've been talking about throughout, is that pKYC piece. It's how can we start to bring biometric in as a bigger piece of the puzzle to ensure that we are, one, maintaining a good customer user experience. It's that friction argument again. It's like, how do you trade off between bad user experience, high friction, with the right amount of friction to ensure the customer actually trusts the process and knows that not anyone could update this information or make this change or apply for X product or whatever. I would say, however, it's not just about the biometrics piece. So I think it is certainly heading towards becoming more of a default, especially in some parts of the world, but I think it's still about having it as part of this broader framework. So I don't think we're going to see other elements of the process go anywhere. We're not going to see, for example, the database checks disappear in the UK because they're super valuable and they give a lot of information, especially if you're needing to verify really specific things like the bank account that someone is providing or confirmation of payee or whatever else. We're also still seeing a lot of interest, maybe less on the pKYC side, but in kind of registry updates for businesses and whatever else. So biometrics is still really core to the process, but it's kind of a bigger piece of the bigger puzzle, which is trying to ensure that you are onboarding and monitoring these customers on an ongoing basis.
Yeah, I think that's a very good way of putting it, actually, is that it is a big puzzle with lots of pieces, and biometrics is just kind of one of them, isn't it? I think we certainly see that across the other verticals that we work in as well, such as e-commerce and marketplaces and things like that, where there's obviously much less of a compliance requirement, but which does enable, but maybe biometrics is actually a sort of a bigger play there, because there's it's a more freedom, I suppose. Yeah,
interestingly, it becomes more of a trust play in those spaces. You're less caring about the regulator, which is why it's super interesting, because they could get away with doing meeting a much lower standard, but that's where it starts to become that competitive advantage. It's we don't need to do this, but we're doing this to protect you, to protect ourselves, to protect others. And I guess your gut would probably be, oh, why are people not signing up to their competitors? But it's kind of self-fulfilling prophecy, right? It's these other marketplaces, these other e-commerce platforms, or these other sharing economy businesses or whatever are the ones with maybe the less good quality of like applicants going through the system, which results in a poorer experience, which kind of continues. So.
Yeah, 100%. And I think there is, I mean, I've certainly signed up for platforms and thought to myself, like, this shouldn't be this easy. There should be, I would like to have some friction in there, just to sort of, just to give me the reassurance that that I'm going, liaising with a safe business, I suppose. But it's nuts. I know we are pushing on time. I just want to wrap up just quickly. I know we've got there are obviously, as we just mentioned, it's kind of a sliding scale. Some businesses are kind of embracing this wholeheartedly. Others maybe with a little bit more of a prod and sort of getting there a bit more reluctantly. But if there is a financial services business that is sort of thinking, right, we really need to get this sort of this pKYC up and running, what's kind of the one or couple of pieces of advice that you would offer just to sort of help them take those steps?
So I think, from what I've seen and from what we've worked on with customers, it's been starting small. It's not been trying to, I hate using like business jargony phrases, but boiling the ocean. It's ensuring that you are able to deliver impact, but maybe you're doing it incrementally. So you're not trying to implement pKYC across a whole raft of things. It's maybe you're just doing it for your logins initially, or maybe you're just doing it for certain changes which you deem as high risk. I would say from there, it's really about assessing the triggers on your platform for risk changes or changes or shifts in risk up primarily that you want to keep an eye on, and understanding what would impact those and what information you need in order to make the change. It might be really simple. It might be watch list monitoring, the really common one. It might be something more nuanced. So we talked about compounding and layering earlier. It's this idea of, hey, Chris has come in and he's changed 4 things. Maybe that's enough to push you over the boundary for triggering some pKYC process versus you've just gone in and changed your name from Chris to Christopher. Yeah. And then it's from there really looking at those other high-risk moments. So maybe not the stuff that directly impacts your risk score. Maybe it's not the stuff that would indicate that Chris is going from low to medium to high. It's the stuff which is kind of to the side of that. It's weird logins. So you've always logged in from the UK and suddenly the last 10 logins have come from the middle of the US or something similar. It's looking at changes to information which isn't traditionally associated with identity, like email or phone numbers. Like, they're part of your identity or they're part of that broader picture, but you can't really verify those as easily through the kind of the traditional methods, but they still indicate risk if they're changing frequently. So it's, I guess, starting to look at those start small areas. So how can we have a big impact by monitoring the few things which really cause us pain today? Where are manual teams spending all their time? Where are we seeing potential risks reputationally or regulatory? Assessing what things actually impact those risks, and then looking beyond that as well. But again, it's not about trying to do it all at once. It's an incremental process. It's not going to happen overnight.
Yeah. Do you think it's almost worth taking a kind of a sort of a startup-y sandbox approach to this type of thing? Because I think, obviously financial services businesses, just by their nature, will have some kind of KYC process in place. They have to, right? So there's something there to compare it against already. And is it worth kind of hiving off some of these things? Maybe, I don't know, business from a certain geography, say, or something like that, possibly, or a certain part, maybe it's retail business versus investment, or whatever the breakdown is. Do you think there's some value in doing it that way, and kind of sort of establishing a contrast to how things previously were, and then you can kind of compare the data and so on? Yeah.
So I think, like, shameless plug for Alloy here, but one of the cool things that we allow customers to do is endlessly experiment with what their onboarding flows or their ongoing flows might look like. So exactly as you've said, it might be hiving off a portion, doing a comparison test, so an A/B or champion challenger to say, this is what the old world looked like, this is what the new world looks like. Or even just creating and spinning up additional workflows or journeys that customers can go through in order to be able to test them in the sandbox environment, and then, as you said, progress them to maybe lesser impacted jurisdictions or areas which are causing immediate pain, where it's just like you need to do something about it and you just want to try and have an impact quickly. And then incrementing on that over time, and either rolling it out more or tweaking and kind of revisiting. I would say the other side of this is the periodic piece of it all. There is nothing to stop a business from maintaining a periodic cadence, at least while they're starting to implement the perpetual side. I would say as businesses mature, they can probably start to figure out how the two impact each other. So I've fully re-verified Chris over a period of 2 years. He would normally need to go for a periodic in 3 years. But actually, I'm comfortable because we've done all that re-verification. The last thing happened at the 2-year mark. Maybe we can push things out a little bit further because there's no need to ask him for his documents again or whatever else. And that's where it starts to get cool, is you can start to think about how the two interact, where you will still need to do things on that periodic basis, but where that perpetual piece will allow you to start improving the customer experience across their whole life cycle. It becomes less about the actions they're taking and more about just the way in which they use their platform. No, I love that idea of kind of a phased approach and sort of gradually sort of phasing out this old world as you go. That's really true. So just to wrap up then, what could we mentioned a lot about the sort of the capabilities of Alloy and sort of how you work and so on. What can we expect to see? Is there any big things on the horizon coming up over the next sort of 12 months, 24 months that we think are worth looking out for from you guys, and that you're particularly sort of excited about with the work that you do? So we're kind of digging deeper in the UK market at the moment. We are doing more and more on risk in order to help customers identify where individuals are changing risk, but also help compliance teams identify and manage that risk as well. So really making compliance's life easier. And I guess that's always going to be a big focus here, is ensuring the people who are doing the hard work are able to do that work in a way that causes them the least amount of friction and pain as they're trying to understand potential risks to their business. So the other side of it is some of the work that we're doing with new data providers to ensure that we're on the latest and greatest versions of their platforms. Again, taking advantage of services that they provide in order to ensure that our customers are benefiting from the ability to use Veriff's document or Experian's database or whatever else in order to build up that layered approach over time that's really best in class. And so the other piece, which I kind of referenced at the end, is just continuing to improve the ability to test this stuff and make those changes and tweaks, because at the end of it, the thing that's most important here, or the thing that I think is one of the most important things beyond just the compliance angle, is ensuring that everything you're doing here has a good user experience at the end of the day. You're not doing stuff just for the sake of it. You're not throwing kind of everything at this problem and in the process turning a bunch of customers off. And one of the cool things that we really allow and that we're going to continue to improve on is that ability to test, iterate, improve, optimize over time, rather than just saying this works today, we'll just leave it there. Yeah. And I guess it's also putting the controls for that in the hands of the people who kind of work on it every day, which is compliance, rather than always having to rely on engineering. So being able to make those changes from that compliance angle rather than having to wait for it to become a whole product engineering process, which can take a lot longer. That's it. I fully agree with that, and I think it's exciting times. Things moving quickly, aren't they? It's, with the speed with which new technologies coming out, and so on. So very exciting times, and I think it'd be a great value, I think, for us, for you and I to talk again in maybe a year's time to see exactly how much has changed and whether that progress has been made at all. So let's wrap things up there, because I think this has been great. We've cut an awful lot of ground. Alex, thank you so much for joining us. It was a really good episode. No, thanks, Chris.
And thanks everybody for listening. See you next time.